Good morning, grade 11. Welcome to another lesson, which is the inventory. So today we are going to do the stock evaluation method, especially FIFO. So sit down, have your calculator, a piece of paper, and a pen. So, what is inventory? We refer inventory as a trading stock that is purchased by the business for the purpose of reselling it with the intentions of making a profit. Let's say a learner purchases a packet of sweets and come to school and resells it to other learners. That is an inventory. So we know inventory falls under current assets in the financial position. Okay, now let's look at the inventory systems, which is the periodic and the perpetual. And the periodics means it does not focus on the real time updating of stock balances. The cost of stock sold is not captured at the point of sale. So we do a physical stock count at the end of our financial year to determine the value of the closing stock, while perpetual is the continuously, which means a system that's count for the movement of inventory continuously, and we do the stock count in order to determine the inventory losses. Now let's recap from our grade 10th work. Can you mention the 3 evaluation methods? And also, you are familiar with the term FIFO. Can you define what is FIFO? Just write it down.
And I'm going to be focusing on periodic and perpetual inventory system, comparing between the two so that you can understand the differences between the inventory systems. With the periodic, inventory is updated periodically. That means at the end of every financial year, physical count on stock is done to measure the level of inventory and the cost of goods that have been sold. 2, periodic inventory system is cheaper because it's not done on regular basis. So that means the business saves money by doing the physical count at the end of the period to see the cost of goods sold. And it is usually used in small businesses because it's cheaper. So that means they can actually use it for their business. And with the perpetual inventory system, it is updated constantly, like on regular basis. After stock has been sold, after purchases have been made in the business, if there's any movement of stock in the business, it is updated. And it is expensive because it's done on regular basis. After every movement of a stock, an entry is made to see the stock. Yes. And the cost of sale is calculated on continuous basis. That's what makes it expensive. And it is used in all type of businesses. If you're a small business and you think that it is very wise and convenient for you to use perpetual inventory system, then you should. So yeah. Oh, also, the difference between the two is that in the perpetual inventory system, the trading stock account is used when goods are bought, and in the periodic system, the purchase account is used when goods are being bought. That's the difference. Periodic uses purchase account, and perpetual uses trading stock account.
Here's a practical example of FIFO method using apples. Let's assume you already have 1 apple in your basket. You decide that you want to add more apples into your basket. You go to the grocery store to buy more apples. You have 3 apples in your basket. This means that when you want to eat the apple, you'll start from the bottom of your basket, meaning that you eat the apple that you bought first. You are left with 2 apples. As you work your way up to the basket, you will take the next apple that you bought or purchased after the apple you have 8. By doing this, you ensure that the older apples are used or consumed before the newer ones. FIFO method, it is a common method used in the stock management or inventory management, also in stock controls. This means that the older items are sold or used first to prevent any loss or waste.
In this activity, you are required to calculate the value of stock on hand using the FIFO method. Correct? Correct. Moving on to our information, we have our stock balances. And when we opened our books on the 1st of April 2017, we had an opening stock of how much? Of 100 Rand, right? We want to know how much stock we were left with after all the transactions were accounted for. Let's move on to our transactions. Now, we had a transaction on the 5th. It says we purchased 100 units at 180, right? And then on the 6th, 10 units of inventories purchased on the 5th April are now returned to the supplier. The reason could be that they were damaged or there was something wrong with those 10 units we returned. Okay, now the 10th transaction says issued 80 units to the factory. The 15th one says 50 units issued to the factory. The 20th one says we purchased 20 units at 1 Rand 50 cent each. Now on the 30, two transactions took place. The first one, we purchased 50 units at 1 Rand 70, right? And then 10 units at 1 Rand each were returned to the store out of units issued to the factory. This is how we go with our calculations. We're gonna first start with our opening stock on the 1st April. We're gonna say opening stock of 50 units multiplied by 2 Rand each, which gives us the value of 100 Rand. Now the second part of our calculations will be our purchases throughout the year. On the 5th, we bought 100 units at 1 Rand 80 each, which gives us the value of 180. Then on the 20th, we then bought 20 units at 1 Rand 50 cents each, which gives us the value of 30 Rand. And then on the 30th, we bought 50 units at 1 Rand 70, which gives us the value of 85 Rand. Now, remember, on the 30th, we had two transactions. The last one that says 10 units at 1 Rand each were returned to the store out of the units issued to the factory. Now, this one, we still have the stock with us in our shop. We didn't lose it. We did not return it to the supplier, but it is still with us in the shop. This is why we're gonna account for it as part of our purchases, because we now still have it in the shop. So it will be 10 units multiplied by 1 Rand each, which gives us the value of 10 Rand. That is all our purchases. Now we add them up to find out the total purchases we have in the business, which gives us the value of 305. The 305 added to our opening stock of 100 Rand gives us the value of 405. That is the total stock available for sales. The third part of our calculations will be our returns, the stock that we returned to our supplier. It says on the 6th April, we returned 10 units from the stock we bought on the 5th of April. With this one, we're gonna use the amount 1 Rand 80 cents per unit, because we bought this stock on the 5th April. We only returned it the following day. The reason could be maybe the stock was damaged or there was something wrong with the stock that we returned it to the supplier. This is where we're going to say 10 units multiplied by that amount of 1 rand 80 cents, which gives us the value of 18 rands. Those are our total returns. Now we're going to say 405 minus the 18 rand, which gives us the value of 385. Keep that in mind. Last part of our calculations will be stock that we issued to the factory. We have to minus it from our stock that we have available for sales, because now we no longer have it available for sales. It was used by us. Now on the 10th, we issued 80 units to the factory. Remember, we are using the first in, first out method. Now this 80 units, we are going to minus it from the stock we had when we first opened our books. Remember, we had an opening stock of 50 units when we first opened our books. Then we're going to say 50 units multiplied by the value of 2 rand, which gives us a total of 100 rand. From the 80 units, we are now left with how much? We are now left with 30 units. Now this 30, we're going to minus it from the units we bought from the 5th, which were 100 units. And then we're going to say 30 units multiplied by the amount of 180, because we are minusing those units from the stock we purchased on the 5th, and it was 1 rand 80 cents per unit, correct? The 50 plus the 30 gives us a total of our 80 units, right? Now all in all, it will give us a total of 154 rand. The last transaction took place on the 15th, where we issued 50 units to the factory. Remember, from those 100 units we bought from the 5th of April, we are now left with how many units? We are now left with 70 units, right? So this 50 units we issued to the factory on the 15th is going to come out of those 70 remaining that we purchased on the 5th. This is why we're going to say 50 units multiplied by the value of 1 rand 80 cents per unit, which will give us a total of 90 rand. Those are our total stock issued to the factory. When we add them, it gives us a total of 244 rand. Correct? Now we're going to say the 405, which is the total stock available for sale, minus our returns of 18 rand, and we minus again the stock we issued to the factory of 244 rands. It gives us an amount of 143. That 143 is the stock we now have left with us in the shop, which is the value of our closing stock.
Okay guys, so we have come to the conclusion of our lesson today, and I hope that you have enjoyed watching the video up to so far. So now we're going to do a small recap of what we have learned about inventories, right? So starting off with the definition or term, we have learned that according to the statement IS2 inventories paragraph 6, inventories are assets that are held for sale in the ordinary course of the business, or are assets that are in the process of production for such sale, or are assets that are in the form of materials or supplies that are going to be consumed by the business for the process of production or for the rendering of service. Right, we have learned today that there are 3 types of stock valuation methods, which are the weighted average, the specific identification, and the first in, first out stock valuation methods. But then today's main focus was on the first in, first out method, which is commonly known as the FIFO. So we're going to discuss a little bit about that one. So the first in, first out stock valuation method assumes that the goods that are purchased first will be the one that we are going to sell first, right? So when dealing with the cost determination, it would mean that the oldest cost will be linked to the first purchases, and then the latest cost of goods will be applied to the closing inventory. We have also learned that there are two types of inventory systems, which are the perpetual inventory system and the periodic inventory system. And what we have learned about the two is that the difference is that in the perpetual inventory system, the movement of stock is recorded on a continuous or ongoing basis, but as for the periodic, there is an occasional physical stock count that is done to measure the level of inventory and the cost of goods that were sold. So thank you very much for watching our video. If you have any question about what we have discussed today, please drop it down on the comment section below. Thank you.